Just when Celsius was beginning to drown, Alani Nu had that ring-shaped flotation device available. So I'll decode that introductory statement a bit later in this content, but on May 6th of 2025, Celsius Holdings updated the public markets by releasing its first quarter 2025 earnings report. And I'll be utilizing those financial statements along with notes I took while listening to the earnings conference call and any relevant publicly disclosed information to obviously update you on the recent performance of the two energy drink brands within the portfolio, but also utilize everything as the contextual backdrop for my expanded strategic commentary around energy drinks market dynamics and trends. And when I stated two energy drink brands within the Celsius Holdings portfolio, hopefully that didn't surprise anyone. If you missed the massive news from the last February, Celsius Holdings announced it had entered into a definitive agreement to acquire Alani Nu for a net purchase price of $1.65 billion, comprising of a mix of cash and stock. But while various Alani Nu business updates will be provided mostly at the end of this content, since the M&A transaction was completed on April 1st of 2025 and after the quarterly period ended, it's imperative to remember that activity from that energy drink brand wasn't officially included within the first quarter 2025 earnings report. And then finally, before we begin, I would like to quickly thank today's sponsor, DOS.com. They're building the first adaptive resource platform, think digital clone of your real-world operations for full supply chain visibility and manual process automation. Whether you're balancing spreadsheets or have an existing ERP, they work with brands to make sure there's no gaps. With DOS, simplify everything from orders and inventory to procurement and demand planning. Learn more at the link in the description. But let's officially kick off the content with a quick rundown of the Celsius Holdings quarterly revenue numbers. In the first quarter of 2025, Celsius Holdings had revenue of $329.3 million, which was down 7% year over year. And while that activity now marks the third straight quarter of falling year over year revenue, sequential quarter over quarter revenue activity only slightly fell around 1%. Also, with the addition of Alani Nu in the second quarter, we will see positive year-over-year growth restarted, a bit mostly from the non-comparable acquisition-related aspect. If we break out the quarterly revenue geographically, North America accounted for $306.5 million, which fell 10% year over year, and this negative result was attributed primarily to the timing and structure of its PepsiCo incentive program and elevated retail promotional allowances. On the international side, Celsius had quarterly revenue of 22.8%, which was up 41% year over year. And though Celsius is now seeing consistent quarter over quarter and year over year international revenue growth, that wasn't always the case for the energy drink brand. But that historical, relatively weak geographical performance was mostly attributed to internal decision-making a handful of years ago, as Celsius leadership smartly focused its attention and resources on fueling the insane growth within the US market. But geographical expansion is now one of the most important strategic pillars inside Celsius, presenting significant opportunity for incremental growth over the next 3 to 5 years. And you can already see some of the early international market development groundwork starting to formalize. In the past year, Celsius began sales activity across the UK and Ireland, France, Australia, and New Zealand. Moreover, it was announced in March that Celsius would expand sales and distribution into the Benelux region of Europe through a partnership with Suntory Beverage and Food. But while international performance continues to exceed initial expectations in those expanded markets, geographical revenue, excluding those expansion markets, increased 9% compared to the prior year period. And though Celsius isn't exclusively utilizing its PepsiCo partnership for global expansion opportunities, it's somewhat attempting to emulate the Monster Energy and Coca-Cola international distribution structures. So using Monster Energy as the opportunity guide for international share of total revenue, Celsius has massive runway left, even if comparing these are apples and oranges for several strategic reasons. But let's transition into a collection of quarterly retail sales and distribution updates that I believe are important when trying to understand the Celsius story. And I probably don't need to keep mentioning this, but in the case that someone has been living in a cave the last few years, things drastically shifted for Celsius because of the August 2022 distribution and investment deal with PepsiCo. Additionally, the entire DSD distributor transition was completed by the year end of 2022, and Celsius has now also been fully integrated within PepsiCo's annual planning cycle. In terms of retail takeaway dollar sales performance, Celsius decreased by 3% year over year, as reported by Circana for the last 13-week period ending March 30th of 2025. Though Celsius reported that quarter over quarter retail takeaway dollar sales did increase 2%. But Celsius remained the third largest energy drink brand in the category, with its first quarter 2025 dollar share within the US energy drinks market currently at 10.9%. And I understand that I'm a broken record by stating this, but I'd hate to gloss over that accomplishment, as Celsius became the first brand in over a decade, not named Red Bull or Monster Energy, that was able to capture more than a 10% share in the US energy drinks market. That said, how can Celsius possibly push even further? Maybe towards a 15% share. And maybe that's beginning to sound more crazy as the brand momentum has retrenched a bit. But it's important to realize that there are more than a dozen large US metro areas where Celsius is plus or minus 2 points of a 15-point share. So it really comes down to a strategic growth framework that Celsius recently branded as more people, more places, and more often. But in terms of beverage blocking and tackling strategy, that primarily is achieved by 1, increasing sales velocity and buy rate, but also 2, increasing total distribution points, which is comprised of ACV and items per store. PepsiCo continues to facilitate ACV expansion for Celsius, supporting new customer acquisitions across broad demographics and new usage occasions. But honestly, the energy drink brand is basically at full distribution now, with products sold in around 250,000 locations. So beyond the velocity and buy rate elements, TDP growth will have to come from increased items carried per store. And going forward, Celsius will increase items per store through a combination of product strategies like flavor, format, pack size, and variant expansion. Finally, the company will seek more store placements, like leveraging cold display activity in Celsius branded coolers, as this strategy, especially locating them near checkouts, has proven to be highly effective with increasing impulse purchases. Next, I want to highlight a non-tracked sales channel that sits perfectly within the intersection of that Celsius strategic growth framework. Since the PepsiCo deal, Celsius has been able to expand rapidly into thousands of non-traditional outlets like colleges, hospitals, at-work micro-markets, and restaurant locations across the United States. And these food service placements now represent approximately 13.4% of North America sales through PepsiCo. But over the last few years, I've shared the performance of various non-tracked channels, from Amazon to food service and wholesale clubs, partly because they've played an outsized role in the Celsius brand journey, but also because I was trying to highlight the evolving shopping patterns of energy drink consumers. Yes, convenience still has the largest channel share of US energy drink sales, but brands must adjust to a new marketplace reality, as the Great Shutdown period changed categorical shopping patterns likely forever. And when looking to maximize this new era of functional beverages, a key strategic component should include the driest format. The mainstreaming version of the beverage identity crisis was something I started talking about more publicly in content during the Great Shutdown period, because there was this perfect storm of converging factors that provided an extra tailwind for this ready-to-drink beverage to ready-to-mix powder format expansion trend you're likely noticing more and more as of late within key functional beverage categories. But while Celsius initially started selling its on-the-go energy powder stick packs a decade ago in the vitamin shop, it wasn't until the last handful of years that focus deepened across sales and marketing functions, along with expanded line extensions and even a brand extension into hydration powders. And in the first quarter of 2025, the powder format accounted for slightly less than 5% of total sales, growing about 4% year over year. But why I'm drawing attention to such a minimal portion of Celsius revenue activity is that the powder format will increase in importance with the addition of Alani Nu. The reversed format extension playbook direction of ready-to-mix powders to RTD beverages is what Alani Nu primarily leveraged, and has quickly become the dominant build model process amongst functional CPG entrepreneurs. And I believe we will begin seeing it play out repeatedly within other growing functional CPG categories, thus causing more beverage identity crisis scenarios in the future. But for this final portion of the content, let's shift into decoding that introductory statement by examining the recent activity involving Alani Nu, which, as a reminder, will be officially included within the next Celsius Holdings earnings period. And the big news was that Celsius announced that, according to Circana last 52-week data for the period ending April 13th of 2025, Alani Nu surpassed $1 billion in retail sales. And while I was off by only a few months, my prediction from the 2022 NAC show proves that my crystal ball within the energy drinks category is still working. That type of market expansion is creating a beverage category that can not only support the typical three-man race that happens within the beverage world, but likely increase to 4 or 5 brands that have $1 billion in revenue in the next 2 years. And by the way, it's only a matter of time when the US energy drinks market supports more than $4 billion brands, as current growth rates have both C4 and or Ghost on track for reaching that retail sales level in the next 12 to 18 months. But let's transition into examining considerations surrounding the Celsius and Alani Nu business combination. I believe the acquisition uniquely represented a dream business opportunity where Celsius could have its cake and eat it too, or I guess a better analogy would have been have its energy drink and chug it too. By acquiring Alani Nu, Celsius further strengthens its ability to benefit from expected long-term categorical tailwinds, but equally diversify itself from potential short-term headwinds. Over the last 2 decades, Celsius has been on the right side of this massive evolution within the energy drinks market as consumers continue to move closer towards this 4-way intersection of taste, convenience, nutrition, and functionality. And since energy drinks have been marketed as lifestyle brands that offer beverages with a functional benefit of energy, brand authenticity matters a lot. To go one step further, energy drinks have become status symbols or basically aspirational mixtures representing flavor taste, lifestyle taste, and identity by association. And Alani Nu is equally well positioned to benefit from expected long-term categorical tailwinds, but also complementary and incremental to Celsius in target audience, product innovation approach, and brand strategy. Now, this doesn't mean Celsius will avoid cannibalization risk, but it should be minimal, especially if Celsius Holdings leadership keeps Alani Nu away from PepsiCo distribution. But heading into next quarter, the combined brand platform of Celsius Holdings will have just over 16% category share, trailing only the Monster Energy combined brand platform and Red Bull. Also, because of the insane 70% plus year-over-year growth rate of Alani Nu, the combined brand platform of Celsius Holdings would be considered the fastest growing energy drink brand portfolio of the top 10 categorical competitors. Additionally, if Celsius keeps distribution network continuity, especially in the near term with Alani Nu, it would help the company stay focused on other business integration elements, driving synergies, and staying disciplined on driving the next phase of brand growth. But while distribution gains, especially within convenience and channel expansion, will certainly be included within this next phase of Alani Nu growth, arguably the most exciting for Celsius might be its ability to leverage the brand's additional product formats to access consumers in growing wellness lifestyle adjacencies. Regardless, with the Alani Nu acquisition now closed, Celsius Holdings becomes an even more dynamically interesting company positioned favorably long term. Oh, and with a great balance sheet that keeps strategic optionality available within what I believe is this market volatility fueled opportunistic period. But I hope you enjoyed the first principles thinking that went into my latest YouTube video. If you did, can you do me a favor by hitting that like button? That quick and free action helps YouTube know my content is worth spreading to more people. Also, we're getting really close to reaching my next subscriber goal, and it would be great if you join me on this journey. But to do that, we need to fix the fact that slightly more than 3/4 of you that are watching this video right now are not subscribed to my YouTube channel, and that hurts my feelings. Regardless, I want to thank you for giving me some of your attention and time, and I'll see you on the next one.